Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking gold, and gold was lower on Monday. Following the big French elections on Sunday, we saw gold prices really get hammered down from the highs, probably close to $20 at one point. And what it really comes down to is this: it eliminated a lot of the fear that was priced into the market. And when gold trades from 1275 to 1300 back to 1275, it could look bearish, but essentially the events that started back on April 10th, April 11th, after the Syrian bombing and before the North Korean debacle that led up to the French elections was really a fear trade. It's I don't know what's going to happen. This isn't an economic trade. This isn't a Fed trade. This really isn't even a currency trade as much as it is a flight to quality trade. And we saw that bid to gold, and we saw it trade up high, and we saw it come crashing down just as fast. But it leaves us at a point that's very interesting because gold traded from the middle of March after March FOMC from 1200 to 1275. And that's where it is right now. So all that economics, all that Fed data, all that hearsay, whatever you want to call it, is still priced into the market. Gold is still, I think, in neutral territory now, whereas it may be perceived as a bearish trade given the results of the election, given the risk on trade. However, it's really back where it started before the fear began. So now it's going back to economics. So moving forward, I think that right now it becomes a Fed play, it becomes a U.S. economic play, and it becomes really a technical play. And this week we have some key data. We have U.S. GDP that's going to come out on Friday for first quarter. It's expected to hover around 0. Now, after fourth quarter of 2016, we had 1.9. That got modestly nudged up higher after revision. You're looking at 0% growth in the first quarter. That's going to be a thorn in the Fed's side. While growth is not one of their mandates, it is, however, important that the U.S. have growth along with inflation and price stability and full employment. But it looks to me that this could be a reason why gold goes higher, is because they don't believe the Fed has the ammo it needs to raise rates as aggressively as it wants. And we heard that story in 2015 and 2016. This year, I think it's more of the same. Although the Fed may act a little more aggressively and speak a little more aggressively, gold prices are telling me that the dollar is going to kind of hang in there, and gold prices are probably going to continue to go higher with the uncertainty in the economy. So even after the big pullback, I'm still bullish gold. It is in neutral territory. I'm looking to buy and extend back up north of $1,300 in the short term. This has been Todd Colvin coming to you from the floor of the CME Group.